This is Nightly Business Report with Tyler Matheson and Susie Garrett.
Touching a record, the blue chip Dow Index rises to an intraday high as investors place their bets ahead of a crucial two-day meeting of the Federal Reserve.
Calling it quits, CalPERS, the country's biggest public pension system, will get rid of all its hedge fund investments. Will others follow?
Hard switch, the big money practice used by drug makers that some call immoral and illegal. All that and more tonight on Nightly Business Report for Tuesday, September 16th. And good evening, everyone, and welcome. I'm Tyler Matheson in our nation's capital, where the Federal Reserve kicked off its two-day policy-setting meeting today, and tomorrow we'll find out what the Fed says about its next moves.
And I'm Susie Garrett. But on Wall Street, the focus of investors was also squarely on the central bank. The major stock averages rallied, with the Dow even reaching a record intraday high. The S&P 500 index posted its biggest gain in a month. Now, investors bought up stocks on reports that tomorrow, when the Federal Reserve policymakers wrap up their two-day policy meeting, they'll signal that they are not in a hurry to raise interest rates. With that, the Dow shot higher, closing up more than 100 points. The Nasdaq rose about 34 points, and the S&P was up by nearly 15 points. We have two reports on this Fed-fueled rally, starting with Mary Thompson on the reaction at the New York Stock Exchange, and Steve Leisman with a look ahead at exactly what investors are hoping to hear from the Fed.
A near miss for the Dow Industrial Average as the blue chip index hit an intraday all-time high, but failed to close at a record. After muddling along in the morning, the markets took off right before noon on a report that said the Federal Reserve is unlikely to make any major changes to its outlook for interest rates when it concludes a two-day policy-making meeting on Wednesday. This ignited the markets, along with a report that China looked to juice its economy, with the central bank injecting stimulus into the nation's largest banks. Energy stocks were also a factor in Tuesday's rally, leading the way higher for the markets. Energy stocks responding to an increase in oil prices. Oil prices rising on reports that OPEC is likely to cut production when the cartel meets in November. At the New York Stock Exchange, I'm Mary Thompson for Nightly Business Report.
The Fed is in play, with markets ready to slice, dice, and otherwise scrutinize tomorrow's policy statement for any hints about the central bank's plans to raise interest rates. Two phrases will get particular attention. The first says there is significant labor market underutilization, and there's speculation the word significant could be dropped. That could be a hint rate hikes are nearer, since it suggests the Fed thinks the job market is healthier. The second says it will be a, quote, considerable time between the end of bond buying under quantitative easing and when interest rates rise. Some have suggested the phrase could be dropped, as the Fed wants to be more dependent on the economic data rather than dates. But dropping the phrase could be a suggestion to markets of a possible earlier rate increase.
I think they're going to remove considerable time. I think there will be a bump on Wednesday when that happens. Remember, if you take a look at the Fed funds futures market, they are below the rates that the FOMC members believe are going to prevail at the end of 2015 and 16.
Markets are, to some extent, already planning on an earlier appointment with higher rates. The CNBC Fed survey showed the 37 economists, strategists, and fund managers polled see the first rate hike coming in June 2015. The second survey in a row that they've brought nearer the date for the first hike. And they see the Fed hitting somewhat higher rates in 2015 and 16 than the prior survey. Whatever the outcome, it seems that the market has faith in new Fed Chair Janet Yellen. 44% think the Fed can exit its easy monetary policy of the past several years smoothly. That's up 10 points from the last poll. Just 17% believe it will end badly with a recession or a stock market crash, half the results from the prior survey. And the Fed under Yellen is getting high marks for being clear and credible, even better marks than her predecessor, Ben Bernanke. Will it last? Yellen has a tough road to negotiate in the next several months if she is in fact going to hike interest rates for the first time in 8 years, and she'll need every bit of market faith she can gain to be successful. For Nightly Business Report, I'm Steve Leisman.
And Jared Bernstein joins us now to talk more about the Fed. Jared is an economist at the Center on Budget and Policy Priorities and former chief economist and economic policy advisor to Vice President Joe Biden. Jared, good to see you again. Is the economy, in your view, strong enough for the Fed to stop buying bonds and start raising interest rates?
Well, perhaps yes on the former, but definitely no on the latter. I think that the tapering off of the bond buying program, and we should get to the end of that tether probably at the next meeting in later October, has been going along steadily and hasn't shaken the economy up much at all. However, it is too soon to raise interest rates. So the discussion is, well, when will it be the right time? Janet Yellen is certainly not giving up on a labor market that she still believes is too slack.
Do you think, well, let me ask you this. What would it take for you to say, go ahead, raise my rates?
I would like to see that the unemployment rate come down well within the Fed's full employment range, which is below 5.5%, and not because the labor force has declined, but because people left unemployment to get jobs. I'd also, and by the way, here I really am parroting Janet Yellen, who's expressed great concern about the long-term unemployed. I'd like to see that long-term unemployment rate come down. That's been historically elevated now for years.
So you'd much prefer, as Steve Leisman just said, for the Fed to become more data-dependent rather than time-dependent. Do you think the data will drive the Fed to raise interest rates in, say, 6 to 9 months? Will we be there then?
Well, look, when you talk about the Fed, you're talking about a lot of different people. But I do think the people who, I don't want to say matter the most, certainly Janet Yellen, are much more data dependent than time dependent. And I think it is a matter of not just the labor market in terms of what economists call the quantities, jobs, unemployment, long-term unemployment, wages. I think Chair Yellen very reasonably wants to see some wage pressure in the economy, which has been lacking now for years before she starts talking about tightening.
Now, you've said what you would prefer to see the Fed do. What do you think they will say and do tomorrow? Are you in the camp that says they will drop those two magic words, considerable time or a significant...
I am in the camp that says they will not. And here's my reasoning. I don't think the Fed likes to have its forward guidance pushed around by outsiders. When you think about it, this take the considerable time, those two words, take that out of the statement, that's really come from people outside the Fed who pick up something more hawkish going on, and they've kind of created this buzz. I think this Fed has shown before, and under Bernanke as well, that they don't like to be moved in terms of forward guidance by kind of the chattering classes outside. So I expect them to kind of put their foot down and say, we'll let you know when it's time for us to change forward guidance.
Very quickly, what was the stock market saying, if anything, today about the Federal Reserve? Has it already priced in whatever they think the Fed can do? Because we had an intraday high.
Yes, I think that's probably part of the solution, but part of the reason. But I do think that, in fact, if the Fed takes the more kind of dovish, data-dependent tone that I think and hope they will, that the market actually might get a bit of a bounce tomorrow. It could go either way, but I think the expectation is for the Fed to be more hawkish, to tighten. If the market doesn't see that, I suspect you might see a bit of an uptick.
All right, Jared, thank you very much. Jared Bernstein of the Center for Budget and Policy Priorities. Susie?
Tyler, today's latest report on inflation is sure to be a topic of discussion at that Fed meeting. It appears that inflation is in check, at least at the wholesale level. Producer prices in August were unchanged from the previous month. A drop in food and energy prices helped offset a rise in transportation and shipping charges. Inflation data on consumer prices comes out tomorrow. Now, prices may be stable, but the outlook on the U.S. economy from some top CEOs is a bit weaker. A survey out today of 135 chief executives by the Business Roundtable shows less optimism about the economy, with more of them expecting to see hiring slow down and less capital investment in the second half of the year. John Engler, president of the Business Roundtable, explains why the economy is performing below its potential.
GDP is still limping around. We're going to come in this year around 2%, a little bit above, maybe, but compared to past recoveries at this point, we're way below where we should be. Workforce participation, still way down, and it's especially down when we look at younger age cohorts, so younger workers. And we've got 4 million jobs that we can't fill because people don't have the skills.
But the findings weren't all bad. Most of the CEOs expect their company's sales to increase over the next 6 months.
There was good news also about the nation's poverty rate today. It declined last year for the first time in almost 10 years. The Census Bureau also reported that the poverty rate for children fell for the first time since the year 2000. But median household income last year was flat from the prior year at just under $52,000.
A big change in investment plans from CalPERS, the nation's largest pension fund. CalPERS, which stands for California Public Employees Retirement System, will stop investing in hedge funds, pulling out $4 billion in investments over the next year after saying that hedge funds charge too much in fees and are too complicated. Joining us now with more on this is Amy Resnick. She's executive editor at Pensions and Investments magazine. Amy, nice to have you here with us. This was really a shocker for a lot of people to hear that CalPERS, which is considered sort of like a bellwether of the pension fund system, is dropping out of hedge funds. Do you think this is going to have a ripple effect with other pension fund managers?
I think that any time an institution as large as CalPERS makes a change, even though they have telegraphed this change, the sudden exit that they announced yesterday was a big surprise. But I think their decision will make everyone think about what they're doing and maybe go back and reconsider or review their own internal allocations to hedge funds.
The big complaint out of CalPERS was that these hedge funds are too expensive, they're too complicated, and they didn't get the kind of performance that they want. Do you think that this is an issue for other pension funds?
I think that CalPERS specifically said that with a pension fund their size, which is nearly $300 billion, and the allocation to hedge funds that they had, which was only $4 billion, that their investment there for the price they were paying was not significant enough to get the returns and the results that they wanted. So they've made other choices. I think those numbers, the allocation, the size, and the performance would be something that every pension fund would have to evaluate for itself.
You know, some of the critics of CalPERS' decision, and this is coming from the hedge fund industry, are saying that there are hedge funds and there are hedge funds, and maybe CalPERS just didn't get into the right hedge funds. What's your take on that?
I think that that's certainly something worth reviewing. CalPERS has a capable investment staff, and they made their decisions based on their objectives and their policies. And I think that's their prerogative at this point to say that it wasn't doing what they hoped it would do, so they're going to change direction.
You know, a lot of people are reading these headlines, individual investors. I mean, what is the message here for individual investors who are always looking for ways that they can kind of emulate hedge fund strategies, ways that they can hedge their portfolios against bumpy times in the stock market? Is this kind of a red flag to say, even for individual investors, maybe not a good idea, it's too risky to go into hedge funds?
I think maybe the bigger lesson for individual investors is to know your objectives and make sure that every part of your portfolio is doing what you expect it to do. And in CalPERS' case, they said that the hedging properties of a hedge fund were not substantial enough because they couldn't get a large enough investment there to get that quality for them. But in an individual portfolio, the size and scale are obviously very different.
And, you know, and the other side of that discussion is that, is this the right time to get out of hedge funds? Because there's all these predictions that the stock market is going to go through a corrective phase, and you want to be hedging during a time like that. So, you know, what are you hearing on that? Did CalPERS maybe move too soon?
Well, at the start of this year, CalPERS changed their allocations across the board and started reducing their hedge fund allocation then and increased their allocation to both fixed income and private equity. So they clearly seem to think that that is going to give them the stabilization in their portfolio that they want.
All right. Amy, thank you so much for coming by, explaining it all to us. We appreciate it.
Thanks for having me.
And we've been speaking with Amy Resnick at Pensions and Investments magazine.
And one more pension fund item that just came out today. Virginia's Attorney General filed a more than $1 billion lawsuit today against 13 large banks and financial firms, saying They defrauded the state by selling risky mortgage-backed securities to the state's public employee retirement fund ahead of the financial crisis. Well, still ahead, manipulative, unethical, and illegal. That's how an attorney general describes what a drug maker does with a widely used treatment for Alzheimer's. That story next.
Summer officially ends 1 week from today, and there's already some good news for drivers this coming fall. Even though oil prices spiked today, up nearly $2 a barrel, gasoline prices this autumn are expected to be the lowest in 4 years. How low could they go? Jackie DeAngelis has more.
Well, fall is about to officially kick off, and there's some good news for consumers. Retail gas prices could potentially fall to their lowest levels since fall of 2010. The current national average for a gallon of regular is $3.37, but we could see prices as low as $3.15 to $3.25, and more than 30 states could see prices fall under $3 a gallon. Now, whenever prices fall, analysts predict that consumer spending could rise. Gas Buddy says that consumers will spend $2.5 billion less this fall on gas than they did last year, and that money can trickle into other areas of the economy. Now, a few reasons that gas prices have fallen so low. The first is the steep drop in both international and domestic crude prices over the past few weeks, but also the switchover from summer blend of gas to the winter blend. The latter is cheaper, and demand also decreases in the fall, so when demand drops, prices drop too. For Nightly Business Report, I'm Jackie DeAngelis.
Cheaper fuel could be a big help for Boeing. The aerospace giant just secured a massive multi-billion-dollar contract with NASA to build so-called space taxis. They will bring astronauts to and from the International Space Station instead of relying on Russian spacecraft, as NASA now does. Well, some flight attendants could be lifting off into retirement with an extra $100,000. That's how much United Airlines will offer in buyout packages to some flight attendants if they agree to retire early.
Two giant drug makers are teaming up to make a new Alzheimer's medication. British pharmaceutical giant AstraZeneca signed a deal with U.S. rival Eli Lilly to receive up to $500 million in funding if an experimental treatment they're both working on proves successful. Investor reaction was mixed. Shares of Lilly rose nearly 1% today, but AstraZeneca down a fraction.
News about an existing Alzheimer drug has prompted a lawsuit from the New York State Attorney General accusing a major drug maker of manipulating patients by forcing them to switch medications so the company makes more money. Meg Terrell reports.
In the drug industry, it's known as a hard switch. Drug maker Actavis is discontinuing its older Alzheimer's medicine, Namenda, before its patent expires next year, and focusing instead on an extended release version. That drug, Namenda XR, has patent protection through 2029. Namenda brings in $1.5 billion in annual revenue, so the strategy could save the company billions by leading customers to switch to the new drug before cheaper generic copies of the old one hit the market.
That will be kind of equivalent to Apple introducing iPhone 6 and then making all the iPhone 5 stop working.
Bernstein analyst Ronnie Gall says it's an increasingly common strategy in the drug industry, known as life cycle management. The New York Attorney General isn't having it. Eric Schneiderman filed an antitrust lawsuit today against Actavis, saying the practice is manipulative, unethical, and illegal. Bioethicist Art Kaplan agrees.
Well, a hard switch, I think, is fundamentally unethical. It forces people to pay more for their drugs. It forces, if you will, the payers, including in this case mainly taxpayers who pay for this drug through Medicare, Medicaid primarily, to pay much higher costs.
Actavis declined to comment on the suit, but said in a statement that Namenda XR has significant advantages over twice-a-day Namenda, particularly important in a disease like Alzheimer's that has a high burden of care. Kaplan argues that it's precisely the vulnerability of patients with this disease that makes the strategy even worse.
One of the particularly morally pernicious aspects of trying to do a forced switch is you're doing it in a group of moderate to severely impaired people with Alzheimer's.
Investors were unfazed. Activists' stock traded up today despite the Attorney General's suit. Bernstein's Gal says they might want to take a closer look, not just for activists' future, but for the rest of the drug industry.
This goes to the heart of the entire strategy called hard switch. And to the extent that that strategy becomes illegal, it will be a risk for the specialty pharma group in particular because they have been using this quite often. So this is something that the pharma industry will clearly object to. This is something that we believe the payers will probably support. This is something we think the FTC will support. This will probably become a pretty big fight within the drug industry.
For Nightly Business Report, I'm Meg Terrell.
We begin tonight's market focus with a big buyback from Humana. The health insurance rallied after it announced a new $2 billion share buyback program that extends through December 2016. This replaces a previous $1 billion program. Shares jumped on the news more than 3.5% to $132.37. Shares of SodaStream fizzed on a rumor that it's in talks with a buyer. An Israeli newspaper reported that a British investment fund is discussing a possible purchase of SodaStream for a price that could total $40 a share. That news pushed up shares almost 1% to $31.79. And Sears has tried closing stores and spinning off assets to fix its finances. Now the company's CEO is coming to the rescue. The department store owner has borrowed $400 million from its chief's hedge fund in an effort to infuse cash into Sears for the holiday season. Shares tumbled, though, almost 9.5% to $30.37.
Well, Susie, a better holiday outlook for UPS this time around. The package delivery company says it plans to hire up to 95,000 seasonal workers for the holidays. This is an increase from last year when it was caught unprepared for a boom in online ordering. Shares were up slightly today to $97.96. Meanwhile, FedEx is hiking shipping rates for express, ground, and freight services. The increase of about 5% will go into effect in January of 2015. Shares up slightly today to $154.66.
30 years after it opened for business, the Trump Plaza Casino in Atlantic City, New Jersey, shut its doors today. It's the fourth casino to close up shop in the struggling gambling city this year. And one more, the Trump Taj Mahal, is slated to shut down in November.
We're still 3 days away from the initial public stock offering of the Chinese e-commerce giant Alibaba, expected to be the biggest ever on Wall Street. And today we learned that after the IPO, the company will open its first ever lobbying office here in Washington, hoping to work closely with U.S. trade officials on intellectual property and trade secrets rules. Alibaba has already hired Jim Wilkinson, a former chief of staff at the Treasury Department, as its head of strategic communications. He'll work out of the San Francisco office.
Also in Washington today, a congressional report is blasting federal safety regulators in the GM ignition switch fiasco. The House Energy and Commerce Committee says officials at the National Highway Traffic Safety Administration played a significant role in General Motors' failure to recall millions of defective cars in a timely manner. It said regulators failed to identify the problems with the switches, and they should have acted more quickly. And coming up on the program, rewriting the rules of the classroom and why the school of tomorrow won't look anything like it does today. The second part of our Future of Education series is coming up next. A federal watchdog group is suing Corinthian colleges for alleged predator lending. The Consumer Financial Protection Bureau is accusing the for-profit institute of luring students to take out pricey private loans by touting bogus job prospects and then using illegal debt collection methods. The consumer groups wants the company to pay $500 million in relief for tens of thousands of students.
Well, traditional education uses basically a one-size-fits-all approach to the classroom, with students sitting at their desks while the teacher lectures from the front of the room. But 25 years from now, a new method of teaching will turn the traditional classroom model on its head. In the second installment of our three-part series on the future of education, Sharon Epperson takes a look at the classroom of the future.
The classroom of the future will look a lot different than the classrooms of today. Gone will be the rows of desks with teachers at the front of the class. The redesign of the classroom will look more like a working, living play space.
If you think about the traditional classroom, we have this image of the teacher telling the students to be quiet and waiting for their turn to talk. And I think really the redesign of the classroom of the future is just the opposite. We want them to talk.
With school days filled with student discussion and interaction, the teacher's role will also evolve.
The teacher might be sitting and observing silently. She might be working one-on-one with one child on the floor. She might be giving a lesson to a small group of students. There's an ebb and a flow that happens in the classroom.
As for lessons, they'll be entirely virtual, to be accessed online, on demand, outside of school.
The real power of the technology is to allow them to work at their own pace, to personalize education for them, and then free up class time.
Educators are already experimenting with what is known as this flipped classroom model. It's a glimpse of what's to come and will radically change the traditional classroom experience. For Nightly Business Report, I'm Sharon Epperson.
And finally tonight, some surprising results in a new ranking of the top universities around the globe. Here's the list from QS World University Rankings. In 5th place, California's Stanford University. In 4th, University College London and the University of Oxford, both in England. In 3rd, Harvard University. In 2nd, a tie between 2 more British schools, the University of Cambridge and London's Imperial College. And in 1st place, the winner, MIT, the Massachusetts Institute for Technology. All great institutions, Tyler. And that is Nightly Business Report for tonight. I'm Susie Garib. Thanks for watching.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody, and we'll hope to see you right back here tomorrow night.
I'm Susie Garib with a Nightly Business Report news brief. The major stock averages rallied today, with the Dow even reaching a record intraday high on reports that Federal Reserve policymakers will signal that they're not in a hurry to raise interest rates when they end a policy meeting tomorrow. With that, the Dow shot higher, closing up more than 100 points. The Nasdaq rose about 34, and the S&P up by nearly 15 points. CalPERS, the nation's largest public employee pension fund, will no longer invest in hedge funds, saying they're too complicated and their fees are too high. GasBuddy.com says gasoline prices this fall will be the lowest in 4 years and looking to be trending lower. And United Airlines is offering some flight attendants $100,000 to retire early. Be sure to tune into Nightly Business Report right here on your public television station.